Hello and welcome to NDTV Profit. You're watching IPO Adda, and the company which is coming to the primary markets is Bansal Wire Industries. It's a stainless wire maker based out of North India. The IPO is priced between 243 to 256 rupees per share. It's opening on July 3rd and closes on July 5th. Fresh issue of 745 crores, and that gives the company a market value of little over 4,000 crores at the upper end of the price band. And joining me is Mr. Arun Gupta, who is the chairman of the company, and Pranav Bansal, who is the MD and CEO of the company. Mr. Gupta, good morning. My first question to you is, you're into an industry which is capital intensive, and you're raising around 745 crores. What is the purpose of this raise?
The purpose of this fundraise is for repaying some debt and some more working capital requirements. Because as you know, today we are the second largest steel wire manufacturer in the country, and we are also the largest stainless steel wire manufacturing company. So we are in constant need of working capital, and we keep on expanding every year. That's why, we've grown at about 18-20% for the last 10 years.
Mr. Arun Gupta, can you give us a sense of the kind of industry this is, how big it is, and what is the kind of growth rate that you see in this industry?
Sir, this is a basic industry, steel wire industry. Steel wire uses everywhere, and we are in this industry, or we are in this field since 1938. And we started industry in 85. My father started trading in 1938. Then 85 we start manufacturing, and since inception we are growing. And as you have seen, in last 10 years we have already shown we have increased volume by industry size from 18 to 20% every year. And as a company is growing and country is growing, and demand in each sector, we are in various sectors, demand is growing everywhere. So I am looking at very good future for the industry.
Pranav, can you give us a sense of once you pay up your debt from the capital raise which you're doing, what will be the total debt on your balance sheet at the end of that, and what percentage of that benefit in terms of reduced interest costs will flow through to the bottom line?
Sir, from the 745 crores that we are raising, almost majority of it is going towards repayment of debt. So after we are done with it, we don't see a lot of debt on the balance sheet. And anyways, we are a profitable company. So from our own accruals, it is good enough for us for the last 10, 20, 30, 40 years, and should be for the future as well.
Typically, what are the kind of margins in this industry for you?
Because sir, we have various different products. Today we have more than 3,000 products. So every different product has a very different kind of a market and a margin profile. But on the face of it as a whole, if you consolidate our all products and applications, you will see about 7% kind of an EBITDA margin that we get.
Give me a sense of the product wide, because
this is the main thing here. Here is that all our margins have been very consistent throughout the years, whether you take the last 3 years or 10 years. We have been able to establish a business model where it is more of a cost plus model that we have even in this industry, and that's why we've remained at a very consistent margin.
You have 3 major categories of product, primarily high carbon steel wire, then you have low carbon steel wire, and then you have stainless steel wires which is there. If you can give us a breakdown of kind of margins which are there in each of them.
So high carbon steel wire is the main category that we have, sir, and this is a product that is used majorly in automotive, some general engineering and infrastructure applications, and this is a product where we get about 14-15% kind of an EBITDA margin. And other than that, we have low carbon, which is a product that is used majorly for fencing applications, cables, general engineering purposes. There we get about 4-5% kind of a margin. Similarly, in stainless steel, which is a replacement of other high carbon and low carbon steel wires as well, especially in the consumer durable segment where it finds major applications. And there again we get an EBITDA margin of about 4-5%.
So is there a conscious effort to change the product mix going forward, because you have a high margin product which contributes nearly 22% of your revenue, which is in form of high carbon steel wires, and then you have stainless, which is contributing nearly 51-52% of your revenues there. So is there a conscious effort to move towards a high carbon steel wires which gives you a better margin profile going forward?
Sure, sir. In fact, even today, if you see, we are quite diversified in the types of products that we make or the kinds of applications that we have. So much so that there is no industry in India that contributes to more than 25% of my revenue. Automotive being my largest is still about 15-18% of the total revenue, and then general engineering, consumer durables. So we have tried to broad base ourselves as much as possible over the years, and I would say we will try to make the same effort going forward as well. What I can tell you is that we are also coming up with a new vertical that we call specialty wires, and for it the main application being steel cord, which are basically higher margin businesses that we will try to focus on going forward as well. And especially for steel cord, I mean, we will be the first Indian steel company to make that product. Today the market size of that product is about 2.5 lakh tons, and majority of it is being catered through imports. We will be the first company to get it started. We are getting up a 20,000 ton facility up and running within this financial year to cater to the demand, and other various applications that we could find, for example IHT and OHT wires, which are basically a product that is used for suspension springs in all your EVs. So in all your two-wheelers and three-wheelers and four-wheelers, today the springs that are made in those vehicles are made out of IHT and OHT wire, which is also an import substitute that we are coming up with. So with these kind of products coming up in our future, we are focusing on some higher margin products, and definitely the product mix has been improving every year for us, and hopefully it should continue.
Mr. Gupta, can you give us a sense of the kind of scale that you are in at this point in time? What kind of expansion that you are looking at? Currently, you are in northern and eastern India. West and south is where you don't have much exposure. What is the game plan for that?
At present, we are catering around, total revenue is around 65% revenue is coming from the north only. But we are focusing on west, east and south also, and as the demand is growing everywhere in India, so we will also grow and we will expand our reach to east, west and south.
And to add to that, being the second largest steel wire company today in the country, we still only have 6% market share. So we believe that there's a lot of room for us to grow. And west, east as well as south, they have been good areas for us. We've been growing very well in those areas. And the plan for the future is also to focus on those upcoming areas for us.
So
whereas we are very strategically well located, I would say, in north, because majority of our sales comes from very near by region from our plants.
So are you looking at putting up facilities in southern and the western India so that you can enter those markets?
So I would say, we are a growing company and we would like to grow in the future as well. So whatever the future holds for us, we will do.
Give me a sense of your EBITDA margins.
But yes, we are definitely focusing on West and South India.
Give me a sense of your EBITDA margins. It was at 5.8% for FY24 compared to 4.3% last year. You said that the margins, EBITDA margins in this industry is around 7.5%. What is it that you're doing to take your margins to that profile?
Sir, how we look at our margins is, majorly because of the production that we do. So what we look at is per ton kind of an EBITDA, which is very constant. Percentage wise, the EBITDA can fluctuate because of my raw material prices. So as I said, we enjoy a cost plus model where we are largely immune to any price commodity fluctuation. So because of any increase and decrease in raw material, our margins can fluctuate in percentage, but it remains quite constant in the kg.
Also, if you can give us an idea of what kind of volatility that you can face with respect to the raw material that you get, because your top 10 suppliers give you more than 70% of your raw material, and steel prices are also very fluctuating. They improved a bit and again they are dipping now. So what kind of impact that does it have on you as a company?
So, sir, today we buy our raw material from majorly all steel players, be it Tata, Jindal Stainless, any steel company that makes our product in India today. So we have a quite broad base of our suppliers, and similarly, as I said, we have a cost plus model. So whatever raw material fluctuation there is every month, we pass it on to our customers through a price list mechanism that changes as per the change in our raw material. So we stay largely immune to any cost fluctuation or pricing fluctuation, and this is the reason for our growth over the last 30-40 years. I mean, the only reason why we've been growing at 18-20% every year for the last 10 or whatever years is because of this, and the kind of diversity that we've created in our model, where we do not today rely on one single product or one single industry.
Give me a sense of your new product profile. You spoke about this. You're getting into a new product which is stainless steel cords, which is not produced in India. It's mainly imported at this point in time. You're also setting up a capacity which will come up at the middle of FY25, which is for low carbon steel wires, which is there. When are these facilities going to come in, and what kind of potential they have for you as you go into FY25 and 26?
Sure, sir. Last year our total capacity for the company was about 2.5 lakh tons. While we have just set up a plant with a capacity of 3.5 lakh tons, and it has started operation at the end of last year. So today we have a bigger capacity already, and here our focus is for steel cord. Steel cord is a product that is used in tires, and we are setting up a 20,000 ton facility for the 2.5 lakh ton market size today that there is in India. Apart from that, there are a lot of new products. I mean, every month we keep on adding some of the other new products to our already 3,000 plus SKUs that we have. But yes, definitely we are focusing on steel cord or other specialty wires like IHT, some products like LRPC, which is also a replacement of TMT in some areas of construction. Plus even the high carbon, low carbon and stainless steel wires that we make, we see a lot of potential because we are only at 6% market share of the industry. So there is a lot of room for us to grow, I believe.
So while in the RHP you have mentioned that you don't have long-term agreements with the suppliers for your customers who will be the OEMs, if I can use the word, especially in the auto or any other sector. Do you have the supply agreements in place, especially stainless cords, or steel cords, which you're trying to bring into the market?
No, sir. The reason why we do not have any agreement with our suppliers as well is because of the price fluctuation. What we buy is steel, which is a commodity, and it comes with all different fluctuations every month. So we don't want to restrict ourselves to any kind of a price. So we buy, we buy from our suppliers based on the market prices that there is, and similarly we sell to our customers based on these kind of prices. Because it is a cost plus model, we do not bind ourselves to any long-term pricing agreement.
Okay. My final question to you is on
even in products for automotive, we have pricing for about a month or a quarter kind of a pricing.
My final question to you is with respect to inventory days. You maintain an inventory day of 35 to 40 days, which is good, but it also puts you at risk because of the kind of demand or supply disruption that can come in, because we have seen that happening in this industry. Is this the optimum level of inventory days that you carry and you plan to carry forward, or there could be an aberration here? It can go up from here on.
Sir, we try to manage the best we can, and I believe because of our scale, we are able to manage our inventories in a good level. Towards price fluctuation, what we try to do is, most of our inventory that we have, we try to have order book against most of them at fixed prices as well, for us to be immune to any commodity fluctuation or price fluctuation. Going forward, also I would say, these kind of inventory levels is what we are trying to maintain, and we'll do our best.
My final question is that 11% of your revenues come out from overseas market, US and Germany being one of the top markets where you do exports to. What kind of opportunity do you see in these markets?
Sir, export honestly has been a segment that has been very good to us, and today more than 75% of our export comes from only Europe and US. And as we all know, our product is a very basic product. From a pin to a plane, you will find our wires everywhere. So I would say if any country is growing, you will find use of our wires. So definitely, even in the export market, we see good potential, and that is why we have been growing at this pace.
Mr. Gupta and Mr. Bansal, thank you very much for joining us today on NDTV Profit. Your IPO is opening on July 3rd, closes on July 5th. Price between 243 to 256 rupees per share. It's a fresh issue of 745 crore rupees. That gives you a market value of roughly more than 4,000 crores at the upper end of the price band. Thank you for joining us on NDTV Profit.